right, good afternoon, everybody. Welcome to webinar today. Iron Condors are back. And that's what we're going to talk about today, Iron Condors. Hope you're all well. I'm Dan Sheridan. Glad you're here. Today is for educational purposes only. Class information. So we're going to talk about Iron Condors today, but this is a preview of our new 2-week class, which will be starting 1 week from today. Today's the last day in February. Let's go spring. And so next Wednesday, March 7th, will be the launch of this 2-week class. The class will go 2 weeks. This is a shorter 2-week class. Say, Dan, why are you going 2 weeks? Because I'm going to meet our girls who are in college out in South Carolina for spring break, so this would work well. Going March 7th, 9th, 14th, and 16th. We'll be going Wednesdays and Fridays at 1 p.m. Central, starting a week from today. It's a 2-week class. Each class is minimum of an hour. I usually go anywhere, well, depends. I can go 2 hours, I can go an hour, but minimum an hour. All classes are recorded and archived. So even if you're working, you can come back after work, watch the class. And what's great is we have a button on our class page. You'll have your own special class page, or you can just, unlimited questions, you could put in questions based on the class material, and they'll come right to me. The class cost will be $197, and that's for 4 to 6 hours of class time. I will put a minimum of 6 live trades on during the class. Did I put 6? 1, 2, how many weeks? 2? Excuse me, that would be 4, because there's only 2 weeks. So each week, I'm going to put 2 class trades on live, and I'll follow them all the way through, even if it goes beyond the 2 weeks of the class. And the purpose of the class trades is to show you how to do it, be more from start to finish, help you see how we do it, how we execute this of 7 to 15 days or 7 to 16 days. And the risk management plan, including adjustments. March 14th will be longer duration Iron Condors, maybe from 30 to 50 days duration, and the risk management plan, including adjustments, and we'll be contrasting those. And then March 16th, the last class, and this is, we might be covering much more than this, but this is just, at least you have a basic idea. March 16th, there'll be planned to make $3,000 monthly with Iron Condors, just so we focus on, okay, now where do we go from here? How do we make that plan? I'll also discuss Black Swan insurance, trading Iron Condors more neutral vega, right? So that will be a little more advanced concept, and then trading Iron Condors and futures options. We'll talk a little bit about that, what's working in that area. Note is, again, during the 2 weeks of the class, which will be a week from today, so it'll be starting March 7th at 1 Central, we'll put on a live short duration, a live trade, short duration and long-term duration Iron Condor each week. So whether you like shorter term or longer term durations, we'll do one each week, follow them through from beginning to end so you can see exactly how we do it. So a total of 4 live trades in 2 weeks to show you how to do it. And that's information on class. If you have any other questions, you can email me, Dan at Sheridan Mentoring. So as far as today, let's talk about this subject of Iron Condors. And as we titled this here today, Iron Condors are back, and I'll explain that. If you look at SPX, here's a price chart for the last year. And as you can see, from March to, middle of September, for Iron Condors and stuff, this was easy, easy, beasy, right? What does that mean? It means that a blind squirrel with roller skates and hot pants could have made money during this period of time. Hey, Dan, why could a blind squirrel with hot pants and roller skates make money during that period? Let's take a look. So we have a 7-month period from probably March, April, May, June, July, August, basically through September, 7 months, we're in a range of SPX from 2350 to 2500. You explain to me how you're going to have any trouble on range-bound trades there. This is like you can sit on the couch, you can have your toenail clipper, your can of, what are those potato chips that we used to eat in high school? Pringles or Pringles. They put in those jars. Those are horrible, aren't they? They tasted good at the time. So that would be more of an ideal situation. In the middle of September, things got a little interesting. The last quarter of the year, you're talking basically 3 months. In 3 months, we went from the 2550 area to roughly, near the 2700 area. So basically, in 7 months, we had a 150-point range. Then in 3 months, we had the same 150-point range, which would have been this area basically there. That was a little more challenging. Why was that challenging? It was challenging because the price of SPX went up pretty fast, right? And second, you also had an unprecedented amount of time that the VIX stayed under 10 during this period. I think for any 3-month period since Julius Caesar came to Chicago, VIX was under 10 more than it ever was, right? And then obviously you start the new year, and this is as we're approaching spring, and you got any roller coaster, it's and then watch out below. And during January, were there any indicators that this nastiness was going to occur? Yeah. This January here, it was about 22 trading days. Half of those 22 trading days, SPX was up about 18 points. Right? Almost every day it was up about 18 points. So half of those were up 18, almost 1% or 1.5 standard deviations. And this was very reminiscent, whatever the word is, of 2008, what happened. Before that, you had this kind of speed. And usually when you have speed, Dan, what's speed? Speed is when we get 2-3 days a week where we're moving close to 1% or 1.5 standard deviation in the SPX. And so we had this. Now, did I know or anybody know we were actually going down? No. I mean, obviously we all thought it was going down because we haven't been down in a while, but I didn't. All I knew was anytime I've ever seen where you get this standard deviation or speed increase on the upside, because people are thinking the upside, well, Dan, it was going up, but VIX was 10 or 11. Well, the way you measure speed on the upside is not the VIX, it's standard deviations and speed. And so when you see that speed, 9 times out of 10, the speed doesn't dissipate, right? It turns from an 80-mile-an-hour wind tunnel into a hurricane or something. And that's what happened. It just so happened it went down, but it could have easily gone up, but that speed resulted in more speed. It just turned down, but it could have, if it continued, we would have had the same speed on the upside. Now, could nothing have happened? It could have, but very unlikely. So anyways, that's kind of the market we're in. And then as we went down, what has happened is during this whole period of time, did Iron Condors work? Yeah, but you were getting such little premium. You weren't getting much of you weren't getting room that far away out of the money where you were doing your calls and your puts. And so it was very nerve-wracking. Returns were lower. And so what happened is the market's going down. It took the VIX from, in this area, 9 to 12 VIX. Now we're getting it, much more frothy, but I think the market's more stable in this 18 to 20 range where you're getting more premium than you did in this environment. And you're getting much more room away, probably 60, 70, 80% more room on these things. So anyways, that's a little bit of the environment. Why are Iron Condors back? You get a little more, because the VIX is higher, market's relatively stable now, much more stable than it was a couple weeks ago. So you're getting much more room on your Iron Condors and a little better credit than you used to. So I think this is a good time to focus on Iron Condors the last 2 weeks. And if anybody had Iron Condors on the last 2 weeks, you could type in the chat. Here's what you can type in. Dan, I had an Iron Condor on and it did pretty well. How many can do that? Type that in, because if you said yes, I'd say 95% of you, if you had an Iron Condor on the last 2-3 weeks, you made money, didn't you? Right? Most of you. I'm not saying you couldn't lose on it, but overall, the Iron Condor experience over the last 2 or 3 weeks was very positive. So I anticipate that continuing. That's why I picked for this next class, 2-week class, starting next Wednesday, the Iron Condors. Last week, as I said, in SPX, here's one of my concerns that keeps us on our toes and should keep you on your toes is speed. Dan, define speed. Speed is 1% move in the underlying, or near 1% move in the underlying, in this case SPX, or near 1.5 standard deviations. If you look at the last 6 trading days, Wednesday, Feb 21, down 15 points, VIX was 20. Thursday, Feb 22 of last week, SPX closed at 2703, okay, down 2 points, VIX 1872. Friday, Feb 23, whoa, Nelly, 2747 up 44, and VIX came down, which is expected. Monday, Feb 26th, oh my, boom, boom, up 32, VIX 1580, coming down a little more. And then yesterday, whoa, Nelly, we're not all going to come back, down 35. These are both over 1% moves in the SPX. VIX went back up, and then today we're just kind of putzing around here, right? So out of the last 4 or 5 trading days, to me, is VIX stabilizing from 2 weeks ago? Yeah, we're stabilizing in this 15 to 20 point range. Is price stable? We're getting two-way, right, which is nice, especially with yesterday's down move. When you're getting 3 out of 5 trading days, 1% moves, you got to stay on your toes, right? I think there's good execution relatively in the market. But here's the key. It's one thing doing an Iron Condor, which we're going to talk about, if VIX is 11 or 12 and we move 40 points. It's another thing doing Iron Condors in the current market where VIX is between 18 and 20. You can handle a 35, 32 point move. Dan, why can you handle it now? Because by doing an Iron Condor in today's market, you're not doing it at 10, 11, 12. You're doing it at 18 to 20. So you're getting a lot more room on these things. So anyways, that's the environment we're in. Embrace the environment we're in. For the last 3 years, it's been very easy for a lot of neutral to bullish trades, right? What has the market done the last 3 years? We've gone up, volatility's low. We've gone up, volatility's low. We've gone up, volatility's low. You get the story. So doing covered rights, cash secured puts, long diagonals, put credit spreads, out of the money, put broken wing butterflies where you have 4 times more risk on the downside than the upside. These are all more bullish strategies that over the last 3 weeks, Mary Poppins came through town. The wind is changing, and we're getting a little different weather condition. And let's be honest, does anybody like change? No. You're used to that. You wanted that to continue for the rest of your life. But as in the market, as in life, as in Chicago weather, things change. And you have to embrace it. Just have to learn to drive in different weather conditions. And then knowing when not to drive. When you're getting the week where we started correcting on the downside, when you're getting like plus 45 point moves on the downside in SPX, those are days equivalent to 12, 14 inches of snow in Chicago where we kind of pull off the side of the road. And the reason is because on the downside, execution becomes difficult on these spreads because they're all over the place. It's very difficult. 40-point up days are better than 40-point down days in terms of execution, just because execution is better on the upside. More people are willing to trade. The downside, they like a turtle, they go into their shell. All right, so we're going to look at a few different Iron Condors today. A low A 9-day, give you an example, we'll be talking about short duration, a little bit longer duration. I'm going to look at a Iron Condor and a stock. We'll look at some examples in class of stock Iron Condors. And then if I have enough time, I think I will put on a live trade just so we can talk about the execution. Leanna says, does this mean that double calendars are no longer good? Absolutely not. Sylvester Stallone would say, we're just finishing up a double calendar class this week. We have a session tomorrow and then one Tuesday, and that'll be available for the public. But no, as long as the VIX is in the teens and doesn't broach 20, 21, 22, I think double calendars where your shorts are 8 to 15, 16 days from expiration are absolutely, as they would say in Hollywood, they're absolutely fabulous. They're fabulous. All right, so here's a 9-day SPX Iron Condor. All right, let me jump in here. So here's a 9-day SPX Iron Condor. So if we're looking in this class that we're going to be starting next Wednesday, we're going to talk about two things, right? We're going to talk about shorter duration Iron Condors, maybe 7 to 15 days, 7 to 16 day, and then longer term 30 to 50. Let's get a feel in here where you guys are at, guys and ladies. How many of you pick A or B? A, Dan, I like the shorter duration Iron Condors. B, Dan, I like the longer term. A, if you like the shorter term duration. B, you like the longer term. Shorter term would be like 7 to 15, 7 to 16 days. Longer term would be 30 to 60, 30 to 50. All right, so most of you are type A personality. You like the shorter term. I like the shorter term. But I'll be talking about both because I think it's important to have that perspective, right? And there's a place for both. So here's a 9-day Iron Condor date today. Here's where SPX was when I was looking at it, and VIX was about 19. And so this was the underlying 2747. I sold the March 9, 2810 calls. So that would be approximately 63 points out of the money. And this is a 9-day Iron Condor today. And then on the put side, I sold the 2660 puts, which are approximately, 87 points out of the money. Here's the underlying. So on the downside, we get a little more room than the upside. The delta of the short call in this particular example was 13, and on the puts was 15. Is that how I always do it? No, and during the class, I'll focus a little bit on, depending on the market conditions, how I would structure your beginning Greeks or the deltas. This would be a sample of a type of one we would do. The credit, which is about $2, and the margin is 800, and that's the margin or risk. And you just take the difference in the strikes on the call side or the put is 10. So you have $1,000 of risk for every Iron Condor. 1,000 minus your credit of $2, 200 would be margin of 800. So if I was trying to make 10% on the Iron Condor, 10% of 800 would be 80, right? And that'd be about 40% of the credit if that was my plan. The Greeks, this is a 9-day Iron Condor. I like a lot of times lean just a pinch short, but in these 9-day Iron Condors, a lot of times I'll do neutral, 0. And that's another thing we'll explain in the class. One, we would be 0 deltas, one would be a little bit short, but this would be a sample of how we do it. Your theta is nice and frothy on a 9-day, about 17, quite a few times bigger than your delta, and it's a short Vega trade. So that's a 9-day Iron Condor. You got nice theta, and again, comparing a 9-day SPX Iron Condor today versus a 9-day SPX Iron Condor 2 months ago when VIX was 11 or 12 versus 19, what's the difference? We're getting farther out on our short options, and we're getting a bigger credit. It's as if Mr. Market is coming and saying, you know what? I know you're a little concerned. The market's moving around. I'll tell you what we're going to do. I'm going to give you a bigger credit, and I'm going to give you double the, almost double the room from the price of the underlying. And that's about what you're getting now. So are you able with these iron condors to get more room to absorb some of these bigger moves? Yeah, but it's still, you're surfing 9-foot waves instead of 4-foot, right? Here's an example, and now here's the complete opposite. Now let's look at this. Here's a 44-day iron condor. Would I do a similar trade on the SPY? Yeah, I would. Yeah, SPY is going to be less capital. I would do a similar trade in the SPY. Yes, I don't really trade a lot of SPY, but it's a good vehicle, a good liquidity, and I think it's a good a place to start out with smaller trades. So here's a 44-day iron condor. So with a 44-day, you can see if this is the current price, 27.46, when I took this graph, and I sell similar deltas. Here's a 12 in the short call, how I picked the short strike, and a 15, how I picked the short put. But you can see the difference. My delta is just a little bit short delta, but my theta, instead of being 15 or 16, is only 3 to 4. So the difference in a 44-day iron condor, we get further out on our short strikes. Here's 25.50 for the short put. It's almost 200 points out of the money, right? And on the upside, we're about 130 points out of the money on our 28.80s. So you're getting more room, a little smoother T+0 curve. This is your expiration graph. So you're getting more room, a little bit of smoother curve, but it's longer duration. So you're going to be in the trade a lot longer, and you're not getting anywhere near the theta on a shorter term trade. So is one better than the other? No. I think a portfolio of iron condors should have both. I mean, if I'm doing 10 grand of iron condors, I might do 70% 30 to 60-day iron condors, and 70% longer duration and 30% shorter duration. But and one thing we'll talk about next week, for the next 2 weeks, depending on the market conditions, volatility, I may shift that allocation a little bit. All right, here's an example. How many of you do stock iron condors? How many of you do stock iron condors? Anybody? Well, here's an iron condor that's not around earnings, but be an Adobe. And if you look, this is interesting to me. I mean, usually when you see a gap in a price chart, it's because of earnings, so I don't pay that much attention to it because we can avoid it. But other than that, I like this price pattern for iron condors for the most part, as long as we're avoiding earnings. Because, if you look at even SPX and RUT, it had more defined this, type activity during a little bit of a correction. So this doesn't look bad considering what's going on in the market. Leanna says the stock is very risky. Well, it could be risky, but the price chart alone doesn't show me that, right? I mean, this is probably earnings, I guess, right? Is that right? Anybody I don't follow Adobe, but if anybody follows Adobe, my guess is this is from earnings, right? But I'm just saying from the price chart alone, this isn't bad. Now, Rick made a good point, or he was saying, I consider iron condors and stocks that just had earnings when IV is still slightly elevated. I mean, that's okay. I mean, most of the implied volatility comes out after earnings, but if you can get some stocks where the IVs are still elevated a little bit, but I'm not sure if that makes up for the difference. A lot of times when stocks, after earnings come out, they're still moving around a little bit. But anyways, again, I prefer stocks in SPX, right? And RUT, and some of your well-diversified, very low volatility indexes. The implied volatilities in SPX and RUT are lower than most of your, the stocks you would consider very conservative, right? In terms of movement, be it your Johnson & Johnsons, your Microsofts. I mean, these SPX and RUT is pretty low volatility. But anyways, I don't have a huge problem doing some stock iron condors, even though I would do more in the indexes because you don't have, in the stocks, you have that stock risk, right? If something happened in the stock. Now, the other thing, if I'm doing iron condors in stocks, I'd avoid earnings because that's when you have the big gap and you really can't do anything until it opens. So, pick your vehicles. I think if I was doing more iron condors in stocks, I'd be careful what I picked. Would I do some stocks, maybe lower volatility, a little more stable, and then maybe I'd pick one out of a group like Adobe, Tesla, some that are a little more volatile but give you more premium. Mark says Adobe earnings are on 3/15, and so if I wanted to avoid earnings, I just want to be in an expiration before March. Anyways, so here'd be an example of Adobe. Here's a 37-day iron condor, but I didn't even look at the earnings. I don't really look at this that much. I'm glad, Mark, thank you for telling me. Mark says Adobe earnings are March 15th. So, and I'm looking at April 6th. So April 6th so we'll turn this into a little bit of an earnings discussion. April 6th is going to be, so if this is April 6th, this iron condor, it means that, so here's the question. If Mark's right, Adobe earnings are March 15th, are we going to get the potential wrath of earnings on this expiration, April 6th? Yes or no? If Mark's correct and the Adobe earnings are March 15th, and I'm in the April 6th iron condor, and I hold on to it, am I going to incur potentially the wrath of earnings? Yes or no? I said that meanly, didn't I? Like wrath. Like I know it didn't. Now, Robert says, not if we exit before then, but let me ask you a question. Do you think you're going to get your money on an iron condor before earnings? In other words, if I'm doing the April 6th expiration and earnings are on March 15th, do you really think the volatility is going to come down before earnings? Yes or no? I'll give you an answer before you can type it in. No. No. So this mythology, if that was a word, that I'm going to put an iron condor on it and get out before earnings, it's a mythology, right? Is that a word? It's a mythology. It's not going to happen, right, in most cases. Now, Jim caught a mistake, and he's 100% right. What mistake did he catch? My margin on this trade. So, one second here, and I will show you the mistake. So here's the iron condor, and I'll just talk about this a second. We're at 210, roughly almost 211, selling the 232 calls and the 190 puts. We're selling one April 6, 232.5 call, buying one April 6, 237.5 call. We're selling one April 6, 190 put, buying one April 6, 185 put. So these are 5-point credit spreads. The difference between the short and the long put is 5 points. So our margin would be, I did it wrong, $500, the difference between the strikes, minus my credit of $110. So the margin would be $390 for every one contract. Thank you for catching that, Jim. $390. Now, if I were doing this, and the delta of the short calls and puts that I was doing was 15. So here's the whole gist with these earnings things. Would I put an iron condor on in the April 6th expiration and earnings were going to come out in March? Would I put one on? How do I make the decision whether I put one on April 6th that I'm willing to go through earnings? Is it because of high volatilities? No. If you're putting this on just because of high volatilities, if that's the main reason, you're wrong, you're wrong, you're wrong. Dan, what's the main reason that you would put on an iron condor in April 6th and you would go through the March earnings? Here's the reason. You ready? The reason is based on the last 4 or 8 or 9 earnings periods in Adobe for someone who's watching it. Let's say, and I have never played Adobe, so I don't know, but so I would look at the past, 8 earnings, look at the expected move, and only, let me say that in Spanish, only, right? Only if I think we are going to move less than expectations would I put it on, right? That's the only reason. That's the main reason. Yes, is implied volatility is going to come down after earnings. Yeah, but the stock could be all, who knows, right? You can't do anything until it opens up. What if it goes up $50? You know what I mean? So, but I'm not putting it on just for IV. Now, I'll get the benefit of an IV crush if I have it on and we don't move. But again, remember, when you do iron condors and you're going to go through earnings, it's a spec trade. Dan, why is it a spec trade? Because I can't do anything until it opens up the day after earnings. And it's like Evel Knievel going over the Grand Canyon. Until he goes over, there's nothing you can do to help Evel when he's in the middle going over. And if he falls, right? And so there's nothing you can do to adjust an iron condor until it opens, and to me, that's too late. So anyways, that's just a little bit of discussion on a stock iron condor. And then last thing, I'll go in real quick, and just so we can talk execution, let's put on a live iron condor. So I'm going to put an iron condor on an SPX, and I'm going to put a short duration one in. So right now in SPX, it's relatively stable. Wouldn't you agree? It's relatively stable today. I'm using, for those of you, some of you might be familiar with Thinkorswim, which now I guess would be Thinkorswim is under the helm of the behemoth, TD Ameritrade. You're getting a huge consolidation in the options trading world, aren't you? You've got TD Ameritrade bought out Thinkorswim. You've got Schwab owning Options Express. You have E-Trade, which has gobbled up Trade Monster and Options House. You've got, who else? You get Interactive Brokers, which they didn't really gobble up anybody, right? You've got Trade King, which now is Ally Invest out of North Carolina. And so, Dan, do you think it's great that these companies are being bought out? Is that better or worse for the option trader? What do you think would be my answer? You think it's better or worse that these big behemoths are buying all these option firms? You think it's better for you guys or worse? I think it's worse, right? Again, I'm not a conspiracy theorist. Well, certain things I am. But it's just, I think it's just common, if you have Joe's Italian Beefs, right, in Chicago, and Joe's running it, and Joe is, Joe's running Joe's Italian Beef, and he's making sure the sauce and all the seasonings are fine, and then you get, Walmart buys Joe's Italian Beefs and want to franchise it. A year later, the Italian beef's going to taste like hot dog. I don't know. And it's not horrible. What do I find? I find it's tougher to negotiate commissions. It's tougher to get talking to people, so it's nice to have, I'm not saying there's not some benefits of being a bigger firm. I just don't know what they are, to be honest with you, for an option trader. But I think the, smaller boutique firms, Tastyworks is a new one, headed up by Tom Sosnoff and Scott Sheridan and Christie, and that used to be with Thinkorswim. They founded that, and I think that's an excellent firm. But there's many good firms, but there's pluses and minuses. Anyways, I didn't mean to go off on a whole tangent on that. All right, so let's look at a live trade, and I'm going to look at a short-term one, a 9-day trade. So I'm going to look at the March 9 expiration, so it expires a week from Friday. Today is Feb 28. Tomorrow, welcome to March. I'm excited living in Chicago. March is great. There's hope, right? So a week from Friday would be March 9th, so this would be a 9-day Iron Condor. And in this particular example, I'm going to sell the 28.15 calls. Let me just see where we're at here in the SPX. We are at 27.48.56. We're up about 4 points. Okay, so I'm going to sell the, let me change this. I'm going to sell the 28.10 calls and buy the 28.20 calls. So I'm looking at the March 9 expiration, expires a week from expiration, a week from this Friday. I'm going to sell the 28.10 calls and buy the 28.20 calls. So in this particular example, the delta of my short call is 13. On the put side, I'm going to sell the 20. You know what? I'm going to sell the 26.70 puts. I'm going to sell the 26.70 puts that have a delta of 17, and I'm going to buy the 26.60s. Let me just see if I like that. No, you know what? I'm going to tweak it a little more. I'm going to sell the, hold on here, my friend. So here's what I'm doing. I'm going to sell the 28.10 call. All right, that's I'm going to pick the short strike. 28.10 call. It's got a 13 delta. I'm going to sell the 26.75 put, and it's got about an 18 delta. All right, and here's the position. All right, so this is the current price. My short strike is 28.10. My short put is 26.75. I'm buying my long options 10 points further out of the money. So on the put side, 26.65. On the call side, 28.20. The current price right now, as we speak, is 27.45. Call this an 8-day Iron Condor. My deltas, it's a symbol for deltas, minus 0.73, less than a delta short. Theta, that's time decay, is about 17, and Vega short 28. So, and I'm looking at this and saying, okay, what's a good price? I'll watch this a few minutes, get an idea of the range. It's traded at 210, 215. This is the mid price. And I'll watch it a couple minutes, 205. I'm trying to get, there is no mid price, there's a mid range. So far as I'm watching it for about 30 seconds, I see a range of 2 to 215. This is going to be a credit transaction. So I just watch it for maybe a minute or so, get a feel of what's the mid range. Again, watching the current price just to make sure we're kind of near there, within a point or two of there, and we are. We're right around 27.45. And I'm just watching this, the mid range, and then I'm going to enter my order because it's a credit towards the upper end of the range. So the range here is somewhere between 2 and 215, and I'll come in around 215, and then I may work my way down to the lower end of the range if I have to. So I'm going to come in at about 215. Since it's trading there, I might actually go 220 and then work my way down. Does that make sense? I want to get a good price. I don't know where the fish are going to bite, right? But I don't want them to, you know, I don't want to get filled quickly on this. I mean, I don't want to get filled at a price that I'm thinking, I could have got something better. Isn't it better to wait at 3:45 p.m.? No, not on a short-term trade like this. Why would you want to wait till 3:45, Liana? But no, I wouldn't. I think any time is good. You know, I like a lot of times on a shorter-term trade, wait till the market's open for an hour and then go in. All right. The key is just to be consistent. So we're up, trading around that 215. The range is 2 to 215. We're around that 27.45, 27.46. So now I go in. So it says the mid is 210. I know the range is 2 to 215. I'm going to go in at 220, test the waters. And so even if I'm going to do 20 contracts, right, or 30 contracts or whatever, I like to test the water with 1 or 2, see where the fish are willing to bite. So now I go in at 220. Again, the mid price is between 205 and 215. So I go in at 220. I'd rather start up there, hit the nuclear weapon button. So Leanna says in the last 30 minutes, the market goes crazy. Well, it doesn't always go crazy the last 30 minutes. I don't usually like to enter a trade the last 30 minutes or so. So if we look at this, so 220 credit and it's 212, I'm not getting executed. If they wanted to execute me, they would have, especially with the way things work electronically, they would have done it. So now I go to 215. But all I'm trying to do is what's a fair price right now? Not in 15 minutes, not in an hour. What's a fair price right now? And so now I go to, oh, did I sell it? Did I cancel it? No, okay. So now I'm at 215. I'll let it stew like a cup of Folgers coffee for a few seconds. I'm at 215. My guess is, 210 to 205 is probably where this is trading at. I'd rather come to the upper end of the range and work my way down. Now we go to 210. It says 220, but I can tell you it's not trading at 220 because I'm trading at 215 and 210 and not getting it, right? So here we are, 210 credit, mid is 210, and I can let it sit there a little bit, but if I wanted to see where they're trading at right now at 150 Central on Wednesday, Feb 28, I can tell you they're not trading at 210 right here with the price here, exactly here. You say, why? I'm not getting filled. Right now I could leave it. I think I'm close. My guess is there's just my guess here. Do I think there's an 80% probability when I go to 205 I'll get filled? Yeah. Does it mean if I go to 205 I caved in a lot? No. But Dan, you went from 220 to 205. No. I started in the upper end of the range. Again, remember, okay, I got filled. 210. That's fine. So now I have an idea of where this puppy's trading at, and now I can go in if I want to do some more or whatever. Anyways, yeah, I got filled at 210. All right. Well, folks, I'm excited about this new Iron Condor class starting next Wednesday. I think this is a good time for Iron Condors. We'll be working together on these. Look forward, hopefully, to see a bunch of you. Great price, $197. And you'll be able to go on our website and sign up. We'll be starting next Wednesday at 1 o'clock Central. And remember, if you can't make it live, a couple classes or whatever, they're all recorded, archived, and you can ask questions anytime on those. Jairo says, if I want to trade it bigger, is it better to widen my longs or to trade more contracts? You could usually more contracts. I mean, we can discuss that, but you don't have to widen out an Iron Condor to do more contracts. And as far as Leanna, will I keep it for 8 days until they expire? No, I mean, I would, on all of our Iron Condors, we'll have a 4-step risk management plan of how we set it up exactly. What's our profit target and max loss? When do we adjust? How do we adjust? So we have a plan, and so everything is pretty much, we got the whole 9 yards on every trade, and that's what we'll be doing during the class. Yeah, I'll be covering insurance. That would be under the last class. We'll be dealing with black swan insurance and how to insure these, especially as you're trading bigger size. So anyways, thanks for coming, everybody. Hope to see you next week, and have a great day. Thanks.